John Higgins, Mortgage One. Happy Monday. So what a tough time with regard to the housing market and interest rates. So we're seeing limited amount of inventory as far as the real estate side goes. Contributing factor to that, higher interest rates. Sellers are unwilling to bring their properties to market. And you couple that with just an unrelenting drumbeat of higher rates week after week that we've seen. So we've made a new high as far as the 10-year Treasury goes. We hit 5% on a 10-year Treasury for the first time, I think, since 2006. That happened overnight here between Sunday and Monday. They have come off those highs quite a bit, which is good news, but it has been a very, very difficult time for rates. And although inflation, is in much better shape, it doesn't really translate over to our interest rate environment. Well, we've seen interest rates hit 8% here in the past week. Inflation is well off its high of over 9%, and we're probably somewhere between 3 and 4%, depending on which gauge you look at. That's great news. We've certainly turned the tide on inflation, which is usually the number one enemy of interest rates. But for a whole bunch of reasons, if you look at the update that we've attached here, a lot of headwinds as far as rates go. If this 5% level kind of holds on the 10-year Treasury, that would be great. We've busted through so many what they call resistance levels, where it's kind of try to put a cap on rates. And as we go through those, we have to find a new ceiling, and maybe that new ceiling is 5% on the 10-year, which again translates, at the moment at least to something around 8% on 30-year fixed money. So keep the faith. It looks like, the Fed is not going to jump into the market and raise rates anymore. They're just kind of going to wait it out, I think, to see if they can break the back of employment, because one of the key factors is, employment continues to run really hot, which is great because we need buyers that have jobs to buy a home. But when you really get down to it, the Federal Reserve realizes that to get a complete handle on inflation, drive it back to their preferred number, which is around 2%, they're going to have to do something about the jobs market. And it has been very, very strong, very resilient in the face of all these hikes by the Fed, going from near zero, over 5% on the Fed funds rate. But, until we see that, these rates are probably going to be here. You factor in all the other things that are brought out in the update, the quantitative tightening that the Fed is doing, the unbelievable amount of debt that this country is absorbing on a quarter-to-quarter basis, and the amount of treasury bonds and bills that have to be brought to market to feed the government. The deficits are just completely out of control. So you take all of that together, it's not a very positive statement on where rates are going to go. But if we hold the line here at 5%, we'll keep our fingers crossed that as we head into the winter and into next year, that we might see maybe a little bit of relief. Anything at this point, obviously, would be nice. So we'll let you know how things look. We have a few economic numbers out this week, not a heavy schedule. So it really probably more of the same here as we continue to trend higher and bounce up against this resistance level at 5% on the 10-year Treasury. So we'll catch you next week.